Okay, guys, we'll be back. This is the part three of the candlestick pattern strategy that training that I'm trying to take you guys through. In the previous one, in the part two, we discussed the bullish continuous patterns as well as the bullish reversal patterns. In this particular video, I'm going to be discussing the bearish continuous patterns and the bearish reversal patterns. As you can see on your screen, I have a lot of I think about six of these bearish reversal patterns, and there are a whole lot of them out there, but I could get only six on the screen just for this video. Now if you want to know more about these bearish continuous patterns, you can go to my website, binaryoptionstradingexplain.com/bearish continuous patterns, and you can get all the information you need on these patterns in-depth detail. I have explained everything there on my website, so just go to binaryoptionstradingexplain.com/bearish continuous patterns, and then you will be able to read more about it. I also believe that a link in the description below, so that you can give you easier access to these patterns. For you to read more about it on my website. All right, now what we have over here is about six. I'll be discussing about a few of them as time permits me, and then I'll always give an overview of how it works. Now we have the following three methods. Now the following three methods is a bearish continuous pattern which forms when an existing bearish trend or an existing downward trend is in progress. Now when this pattern forms, what happens is a bearish candlestick forms first, followed by a bullish candlestick which opens at the closing price of the bearish candlestick, but it closes within the body of the first bearish candlestick. Now followed by, it could be a bearish candlestick, and in other cases it's also followed by a bullish candlestick again. So it could be bearish or it could be bullish. Now the second candlestick right here, the one I have the mouse pointer on. So once that also forms, you wait for another um, bullish candlestick to form. Now when these bullish candlestick form, right, you then further wait for a bearish candlestick closes actually. You then wait for a bearish candlestick to open at the closing price of the bullish candlestick. Now when it opens at the closing price of the bullish candlestick, it closes below the closing price of the first bearish candlestick. Now this is how it forms. It forms like a zigzag, something like this way, that way, that way. So it's forms like a zigzag. Now when this forms, this is called the falling three methods. Now this is similar to the rising three methods you saw for the bullish continuous pattern. That's just the opposite of it. So once it forms this way, what a trader does or analysts do is they wait for the bearish candlestick to form, they wait for this bullish to form as well, wait for this bullish or bearish, depending on whichever one it is, to also form, wait for another bearish and bullish candlestick to form, then they wait for this bearish candlestick to form. Now once this bearish candlestick forms and it closes, the moment it closes, they take their trade, which is a put, a downward trend. They know the market is gonna be a downward trend, so they take a put. And when you take a put, you're gonna win the trade if you hold it for a particular time frame. So that is how it works. They also have the three-line strikes. Three-line strike, just like the the bullish continuous pattern as well. Now with this one, what happens is that a bearish candlestick, an existing downward trend forms. It's already in progress. Then a bearish candlestick forms, followed by another bearish candlestick. Then another bearish candlestick also forms. Then a bullish candlestick forms. Now this bullish candlestick opens at the closing price of the last bearish candlestick, but closes above the closing price, or closes above the opening price of the first bullish candlestick. Now once this forms, it indicates that the existing downward trend is gonna continue in that same direction. So that is what this pattern also does. Now we have a neck, we have downside Tatsuki, we have side by side white lane, and then we have on neck. Now these are all continuous patterns that form, and I have explained them in depth and in detail on my website. So I'll be leaving a link below in the description where you can click on it and then go to my website and then read more about these patterns. Alright. So now the next thing I'm going to talk about is the bearish reversal candlestick patterns. Now, if you also want to read more about these, I also have just 6 here, but there are more of it on my website. So you can go to binaryoptionstradingexplain.com/bearish reversal candlestick pattern. Now, when you go there, you can read more about it in details. I've explained everything there in details for you guys. Now, what you can do is, let talk about a few of them. In this case, we have on the screen, we have abandoned baby, we have dark cloud cover, we have 3 inside down, we have evening star, we have evening doji star, we have these are the one is 3 outside down. Now, abandoned baby, just like we saw in the bullish reversal strategy, the bearish also works in the opposite manner. What happens is a bullish candlestick forms followed by doji, after which a bearish candlestick forms, but it opens at the doji price but closes within the body of the first bullish candlestick. So that is how it forms, and once that forms, what traders do is, now you know an existing upward trend is in progress, so the market is moving up. Now once this pattern forms, it indicates that downtrend is about to begin. So what traders do is, once this bearish candlestick closes, immediately this bearish candlestick closes, they take a put, which indicates that the market is gonna go down. So you take a put immediately this candlestick closes, so that you join the existing downward trend in its early stages. So if you will notice, you realize that an existing upward trend is in progress, and once this formed, the upward trend halted and the downward trend began. So that's how it works. Alright, for this one now, for the dark cloud, what happens is this. Now, an upward trend exists, and then a bullish candlestick forms. Now, when it forms, a bearish candlestick then forms next. But this bearish candlestick, what happens with this bearish candlestick is that it opens at the price of the closing price of the bullish candlestick, but when it closes within the body of the bullish candlestick, but it covers 3/4. You realize the body of this bearish candlestick covers 3/4 of the bullish candlestick, leaving it with just 1/4 of it. So if a bullish candlestick forms in an existing upward trend, and a bearish candlestick also forms beside this bullish candlestick but closes 3/4 away, I mean 3/4, the body of this bearish candlestick, it covers 3/4 of the body of this bullish candlestick. It implies that this is a dark cloud cover. Therefore, traders take their trade, or analysts take their trade immediately this candlestick closes this at this price. Once it closes, then an existing downward trend is about to, an existing upward trend is about to pause and a downward trend is about to begin. So you can also use a strategy. So once this candlestick closes, you take a put. And then once you take a put, you're gonna win your trade. You go for a particular time frame. So that is how this strategy and this pattern also works. Now we also have the 3 inside down. They work in a similar manner. We also have the evening star doji. They work in similar manners as well. And with the evening star doji, you have a bearish a bullish candlestick forming, then you have a hammer, inverted hammer. Now this is an inverted hammer. It has a small body, little wick, little lower wick, and a very long upper wick. So this is a hammer. So what you do is you wait for a bearish reversal candle, a bearish candlestick to a bullish candlestick. Sorry, a bullish candlestick to form. And once the bullish candlestick forms, you also wait for a hammer to form. Now once the hammer forms, you then wait for a bearish candlestick to form, which opens at the closing price of the hammer, of the inverted hammer, and which is a bullish inverted hammer. And then once it opens at that price and closes, you take a trade. So as an upward trend gets to the hammer, a reversal takes place, and then once this closes, you take a trade. So that's how it works. Now in the next this is part 3. I'll be discussing the next video. I'll be giving an illustration of how to use this on a MetaTrader 4 chart and how you can use it in making your trading decisions. I'll be illustrating that. I will be using the 3 inside down and the 3 outside down to illustrate that. So join me in the next video, and then let me show you how you can do it and how you can set it up and how you can use it on your own. Alright, thank you for making time to watch this. So see you in the next video, and let's get everything done. Alright, take care.